Hello. Today I'm going to present my second video presentation regarding the capital market. Last time I already shared with the idea of why we need the capital market and what are the necessary conditions that a nation can fulfill to establish a fully operational capital market and the factor influencing the capital market both in African context as well as on the Ethiopian context. Today I'm going to share the idea of the investment environment on the capital market establishment. So the investment environment in the capital market is a bit wider, so I'm happy to disaggregate it into two components, part one and part one, part two one and part two one. So in the first sections of the investment environment under the capital market, I'm just going to cover what does mean investment, what is real assets, and what is the difference between real assets and financial assets, which means real assets versus financial assets, and what does mean financial asset as well as the financial market in the economy are the issues that I'm going to cover just today. So I hope you'll get it very helpful and you'll share me your comments and thoughts regarding these pointers. So capital market investment environment, just as that of the real market investment environment, we just simply define the term investment. So investment is the current commitments of money or other resources in expectations of reaping the future return or future benefits. For example, an individual might purchase a share or a stock by anticipating that the future proceeds or the future return from the share will justify both the time that his or her money is tied up as well as the risk of the investment, So, although investments differ in many ways, but the all investment activity may share one key attribute, that is the central of all investment activity. That means you or the investor sacrifice something of value now by expecting the benefits from that sacrifice in the future period or in the latter period of time. In the category of real versus the financial assets, as we all know, the material wealth of a society or a given nation is ultimately determined by the productive capacity of the economy, that is the goods and services that the economy produce or creates in a certain period of time. But in turn, this capacity is a function of real assets, both the land, the buildings, the machines, the knowledge that can be used to produce or transform the input to the goods and the services. In contrast to the real assets, financial assets such as stock, bonds, and securities are just simply a sheet of papers, or more likely the computer entries that they do not contribute directly to the productive capacity of the economy of a given nation. Instead, these assets, which means the financial assets, are a means by which individuals in a well-developed country's economy hold their claims of the real assets. So financial assets are claims to the income generated by the real assets or the claims of the income from the government. Sorry. While financial assets generate a net income to the economy, real assets generate net income to the economy. Financial assets simply define the allocations of the income or the wealth among different types of the investors. So individuals can choose between consuming the wealth that he generates today or investing for the future time. If they choose to invest, they may place their wealth in a financial assets by purchasing the various kinds of securities or bonds. When investors buy those securities from the companies, the firms use the money that get from the sale of those securities to raise or to pay for real assets such as the plants, the equipment, and the technology in order to generate the income in the given nation's economy. So investor returns on the securities ultimately came from the income produced by the real assets that were financed by the issuance of those securities. So household wealth includes both the financial assets such as the bank accounts, corporate stock or bonds, as well as the real assets, the land and the building and the companies. However, these securities, which are the financial assets that households, the financial assets as for the householders, but they are the liabilities for the issuer of the security of the financial assets. Generally, there are common classifications of financial assets, which means the financial assets can be broadly or commonly classified as fixed income assets, the equity, or the derivative assets. So the first one, the fixed incomes, or sometimes you call it the debit securities, are the promise either fixed streams of income or streams of income determined by a specified formula. For example, a corporate bond typically would promise that the bondholder will receive fixed amounts of interest on each year. In the other way, there are kinds of bonds. We have floating rate bonds. These floating rate bonds are just simply promise payment that the customer get depending on the current interest rates. So floating rate bonds is mainly affected or determined by the current interest rate, whereas the fixed income bonds, they are determined by fixed amounts of value or a kinds of formula. So in this case, in the fixed income securities, unless the borrowers declared bankruptcy, the payment of these securities are either fixed or determined by the kinds of formula which is agreed by the sellers and the buyers of the bonds. For this reason, the investment performance of the security of the fixed income country is least closely tied with the current conditions of the issuer. Hence, fixed income security came in tremendous or variety of forms or maturity dates and payment provisions. The maturity date may be 5 year, 10 year, or any other kinds of years that the seller and the buyers of the securities agreed, as well as the payment provisions is also agreed on the both the seller and the buyers of the security. So the money market refers, which call it the debit security that are short time, highly marketable, and generally of very low risk. Such kinds of debit securities like a treasury bill or bank certified deposits are less risky and highly marketable. In contrast to such kinds of security, sorry, there are other kinds of securities which we call it long-term fixed income securities, such as the treasury bonds, as well as bonds issued by the federal agency, states and local municipality, and also corporations like Tele and the like. ELPA and like can issue bonds. So these bonds ranges from very safe in terms of default risks. Example, treasury securities are, we call it very safe, but relatively risky securities we can also mention as a high yield or junk bonds. Junk bonds. Sorry. Uh, They are also designed with extremely diverse provisions regarding the payment provided to the investors and the protection against the bankruptcy of the issuers. There is also a need of issuing protections against the bankruptcy of the issuing corporations. There may be a bankruptcy or a default of the company that issue the security. In this case, we need to protections against such issue. The second kind of financial assets is an equity. Unlike the debit security, common stock or equity in the firm represents an ownership share in the corporations, which means equity holders are not promised any particular kinds of payment. They receive any dividends the firm may pay and have prorated ownership in the real assets of the firm. That means equity is depends on if the firm is successful, they will get higher amounts of dividend. If the firm is not performing well, they may not be get any kinds of dividend. So if the firm is successful, the value of the equity will increase. If not, it will decline, which means the performance of the equity investment therefore is tied directly to the success of the firms and its real assets. For this reason, equity investment tend to be riskier than investments in debit securities or fixed income kinds of securities. The third kind of financial assets is a derivative security. Derivative security, such as options and future contracts, provides payoff that are determined by a price of the other assets, such as the bond and the stock prices. As a result, derivative securities are so named because their value are derived from the price of the other security. Other important derivative security, and we can mention as a future and swap contracts. Derivatives have become an integral part of the investment environment because the primary use of the derivative is it's used as a hedge against the risk, or it can simply transfer the risk to the other party. So the use of the security for the risk management is so commonplace in the current capital market. That multi-trillion dollar market in derivative asset is routinely taken for a granted base because of the nature of these derivative securities. So derivative also can be used to take highly speculative positions. So the losses in the derivative security attracts considerable attentions, and they are in fact the expectation to the more common use of such securities as a risk management tool because of it used as hedge against any kinds of risk. The derivative securities is one of the best risk management strategy or tools in the capital market. So derivative will continue to play an important role in the portfolio constructions and financial systems of any nations. So firms engage in international trade regularly transfer monies back and forth between dollars and the other currencies. For example, in London alone, nearly $2 trillion of currency is traded each day using this capital market. So investors also might to invest directly in some real assets, unlike the financial assets. The commodity and the derivative market allows firms to adjust their exposure to the various business risks. Wherever there is uncertainty, investors may be interested in trading their speculator or lay off their risks, and the market may arise to manage that demand. that demand. The other important point that I wish to share you today is the financial markets in the economy. We stated earlier that real assets determine the wealth of an economy, whereas the financial assets merely represent against or represent the claims of the real assets. So financial assets and the market in which they trade play several crucial roles in the developed economies. Financial assets allows to make the most of economy of the real assets. Because of the presence of the financial assets, the economy real assets may properly perform. The other important thing that we need to know or we need to briefly understand is the capital market is the informational role of the financial market. Stock prices generally reflect the investors' collective assessments of a firm's current performance and future prospects. When the market is more optimistic above the firm, its share price will rise. Whereas if the price of the shares is getting lower, means the firm may not perform higher. That means the higher the price makes it easier for the firm to raise capital. If the price of the share or the stock is getting higher, which means the market prospect or the return that we get from the security that we are going to buy is more promising. As a result, the sellers of the security can easily sell out its shares and collects a large amounts of money to encourage his investment activity. In this manner, stock price plays a major role in the allocations of capital in the market economies. By directing the capital to the firms and the applications with the greatest prevalent potential. But we also need to be cautious about the trends, the performance of the securities, which means no one knows with certainty which venture will succeed and which will fail. Even if we have done a lot of financial analysis or time series analysis regarding the performance of the stock or the securities of a given firms, it may not be certainty. There are a certain degree of uncertainty within the model that we use to predict the success of the firms. So it is therefore unreasonable to expect that the market will never make a mistake. There may be a mistake in the market. The market may be get down because of certain reasons, some internal or external reasons. Therefore, the stock market encourages the allocations of capital to those firms that appears at the time to have the best prospectus. And many smart, well-trained and well-paid professionals analyze the prospects of the firms whose shares trades on the stock market, which means there is a need of economists, a need of statisticians, a need of mathematicians, a need of computer programmer who can run the modeling of the financial market to predict the future prospectus and the trends of the market. But in the Ethiopian case, I hope there will be some challenges because we may not have the backward data of the companies that they wish to engage the newly established capital market. Without the enough amounts of data, it will be very difficult to predict the future prospectus of the companies in a certainty or in a more precise manner. So data availability may be one of the challenges for the newly established capital markets in Ethiopian context. So stock price reflects the collective judgment of the investors. The other important thing that the financial market, so the capital market, help us for the societies. It helps us to smooth the consumption timing. Some individuals are earning more than they currently wish to spend, whereas the other will spend more than they earn today. But in this case, how can you shift your purchasing power from high earning to low earning period, or how can you smooth your consumption pattern? One way is there are a number of ways to smooth your consumption pattern. One way is to store your wealth in the financial assets. That means in the high earning period, you can invest your financial in the financial assets such as in the stock in the bond market. And in low earning period, you can sell those assets to provide funds for your consumption needs. By so doing, you can shift your consumption pattern over a course of your lifetime, thereby allocating the consumption to a period of time that provides a greatest satisfaction. Thus, financial markets allow individuals to decisions concerning the current consumption from that of otherwise would be pressed by the current earnings. The other important thing in investing in financial market or capital market is allocations of risk. Capital market helps us to allocate the risk that we face in investment activities. Virtually or truly all real assets involves some kinds of risk. So capital market allows the risk that is inherent to the real estate investment to be borne by the investors must with which bears the risks. So the allocation of risk also benefits the firms that needs to raise the capital to finance their investment. Which means if some investors want to allocate the risk, he will buy a financial asset from the other more secured financial markets. In this case, the one who sold out the securities can get a large amounts of money to implement his planned investment activity. When investors are able to select security types with the risk return characteristics that best suits with their preference. As last time, as I mentioned, risk and return are directly related. The investment activity which have a higher amounts of return is usually have a higher amounts of risks. And some by behavior, some of the investors are risk level, some of them are risk averse. So based on the preference of the investors can use the capital market to buy and sell the security. So this facilitates the process of building the economy state of real assets, which means when the finance is going on out to the market, the real assets can benefit from that activity. The other important thing is the financial market helps us to separate ownership and management. Many businesses, sorry, the other important thing of the capital market is used as to separate the ownership and the management. Many businesses are owned and managed by the same individual currently, since the size of the firms or the businesses are very small. And this is a simple kinds of organizations is well suited for small business, and in fact was most common from the business organizations before the industrial revolutions. But currently the size of the business is getting higher and higher, so it is difficult to manage them by the owners of the management. So today, however, with the global market and large scale production large scale productions, the capital requirement of the firm have skyrocketed. There is a need of very huge amounts of capital, very huge amounts of capital. It cannot be managed by a single individual. For example, at the end of 2050, General Electric listed on its balance sheet about 57 billion of property, plant and equipment, and the total assets of about 493 billion. Imagine, this is a huge amount of money. It cannot be managed by a single individuals or the owners. So corporations of such size simply cannot exist as owner-operated firms. Actually, the firm has more than 500,000 stockholders with an ownership of the stake of the General Electric, and is the firm proportional to their holdings of the share. These 500,000 shareholders in the General Motors may not be involved in each and individual's decisions or management activity. Such a large group of individuals obviously cannot actively participate in the day-to-day management of the firm. Instead, they elect a board of the directors that in turn hires the supervisors that manage of the firms. And this structure means that the owners and the managers of the firms are different parties. So this gives the firms stability that the owners managed the firm cannot achieve. Achieve, which means owners managed firms may not have stability, but in case of the board-owned management styles, it can bring stability to the firms. For example, if some stockholders decide they no longer wish to hold shares in the firm, they can sell their shares to the other investors with no impact on the management of the firms. Thus, financial assets and the ability to buy and sell those assets in the financial market allow the easy separations of ownerships in the management of the firms. The other important thing that we need to consider when you operate the capital market is the corporate governance and corporate ethics. We need to be ethical. We need to have a good kinds of corporate governance. We have argued that securities markets can play an important role in facilitating the deployment of capital resources to their most productive uses. But market signals will help to allocate capital efficiently only if the investors are acting on accurate information. Without accurate information, if the security issuer displays a wrong information, which means the buyers of the security may be misled, and the money that the sellers also get may not be used properly. So we say that the market need to be transparent for the investors to make uninformed decisions. The balance sheet and the trends and the stats of each firm that's involved in the capital market must be properly displayed with accurate information to help the buyers and the sellers of the capital market to make informed decisions. But in some cases, if such kinds of situation may not be fulfilled, and if the firms can mislead the public about their prospectus, the, the there will be much can go wrong, which means the market may distort the economy as a whole, and also the buyers as well as the sellers may not be benefited from the capital market. So corporate governance and corporate ethics must be the crucial issue. We must act ethically based on the given rules and regulations of the financial markets of a certain country. So this is all about today. I'll continue the second part of the investment environment and the capital market for the next week. If you have any kinds of suggestion, comment that can help us to improve the presentations as well as to complement the presentations entirely, you're welcome. Once again, I want to remind you, if you like this video presentation, please don't forget to subscribe it, write your comment and suggestions, and thank you. Have a good night or a good day wherever the timeline you have. Thank you very much. Once again, see you next week.